Hello, everyone. Welcome to Webinar Wednesday with Cando. My name is Paul Macedo, Communications Director with Cando. We're just admitting all the folks into the session. So as a reminder, if you can please make sure that your microphones are off during the presentation. We'll have plenty of opportunity for question and answer, and at that time, we can turn your microphones on if you so wish for you to ask your questions. In the meantime, if you do have a question, I would prefer that you use the chat function to list your question, and that way we can queue that up for our presenters without interrupting the flow of the presentation. And then we'll go through all of those questions in order. This session will be recorded, and any presentation materials can be provided via the website. You go to Cando, you don't go to Cando actually, it's edo.ca, but it is Cando's website. And you go through the links to learning, and under the links to learning, there's a webinar Wednesday, and we'll have all the materials, including the recording, posted there. So we're just admitting some more folks into the session. So we'll continue to do that before I introduce the presenters for today's session. So again, materials will be available at the Cando website at edo.ca. Go to the links to learning tab at the top and then select Webinar Wednesday, and you'll see the recording and all presentation materials there. Probably later today, this afternoon. So in about 2 hours after the session is over, we'll have the materials there for you. So this session is with BMO, Bank of Montreal, and it's business planning and finance with from a lender's perspective. And we'll just, we're right at the hour. So I'll continue to admit people, but we'll start with their introductions. My name is Paul Macedo, Communications Director with Cando. I'm speaking with you today from my home, Treaty 6, home of the Cree, Saulteaux, Blackfoot, Métis, Dene, and Nakota Sioux. It was home and also a traveling territory for those Indigenous groups. So it's my privilege today to bring you Webinar Wednesday with BMO, Bank of Montreal. Today with us is Cloyd Bathan, Doug Bourque, John Pereira, and Dejan Dimic. And Cloyd, do you want to take it away?
Sure. Thanks very much, Paul, and welcome everyone. Appreciate you all taking the time today and joining us in our conversation. As Paul mentioned, my name is Cloyd Bathan, and I am a Vice President of Indigenous Banking with BMO Bank of Montreal for Alberta and Northwest Territories. I'm speaking to you all today from Treaty 7 territory in southern Alberta. I'm very fortunate and grateful to live and work 10 minutes south of Calgary on the traditional lands of the Siksika, the Piikani, and Kainai of the Blackfoot Confederacy. So now I'm just going to pass it on to my colleagues to introduce themselves. Maybe Doug, start off with you.
Sure. Good morning, everybody. My name is Doug Bourque, and I am the Vice President of Indigenous Banking for BMO for British Columbia and Yukon. And I'm speaking to you today from the unceded traditional territory of the Coast Salish people, predominantly where I am today in Victoria, the Songhees and Esquimalt First Nations. And pass it over to John, who's with me. Introduce yourself.
Hello, everybody. John Pereira, Senior Relationship Manager. And I am here as well in terms of the territory with Songhees and Esquimalt Nations. And I have the distinct privilege of being part and providing support for over 25 First Nations on Vancouver Island and surrounding areas. Pass it on to Dejan.
Good morning. I'm Dejan Dimic, Senior Relationship Manager located in Edmonton. I've been working with BMO for 3 years and in the industry since 2014 with a focus on Indigenous banking services. I would like to respectfully acknowledge that I'm speaking to you all today from Treaty 6 territory. I'm very fortunate to live and work in Edmonton on the traditional lands of First Nations and Métis people, whose presence continues to enrich our vibrant communities. And with that, I'll pass it back on to Cloyd.
Great. Thanks very much, guys. Title of our workshop is Business Strategies and Planning. Doug and I are going to speak on a high level as to, a lender's perspective, what we look for from potential clients when assessing a proposal for financing. After our discussion, we'll pass it on to John and Dejan, who's going to speak on actual live case studies, how the process went, what challenges there were, and what the outcome was. And before we begin, I'd just like to say that what we're going to talk to you today about and the principles is not specific to Bank of Montreal. This is industry-wide. Any prudent lender will follow these same principles. And so if you can take something away from this workshop, that's fantastic. So Doug, I will pass it off to you to kick it off.
Sure. Appreciate that, Cloyd. My opportunity is to speak to you about a document that everyone who's approaching requiring financing on any project will have to provide, and that's the actual business plan itself. And specifically the certain parts of the business plan that will help tell the story that you want to help sell your idea and why you want to make the investment in this particular project. Basically, at a high level, the business plan will have an executive summary, and that basically is an overarching glance of the opportunity that you're wanting to pursue, a bit and why you're making that specific investment in that particular industry, and of course who's involved in this process. As we move down, the business overview comes into play, and that's more specific to the industry in which you're going to be proceeding with, and the specifics to potentially in the area where you're at and why you're going in this direction. And then moving forward down, you get into the sales and marketing aspect. This is highly important because it's going to also indicate as to how you expect to create the sales, potentially some of the team that you may be required that's going to be involved in the marketing aspect. May also touch on industry expertise that you have and why it'll make you more competitive than some of your competition, if there is any. Moving down into the operational plan, and the operational plan will get in more to specifics on how you expect to deliver the product or provide the service that you're making the investment towards. This will include likely talking about the people that you intend to employ, the industry experience that they have, and implementing a efficient team of moving forward in actually delivering the product or service. Moving down further, you go into the management team, and this is highly important to the bank because this is one of the major things that any financial institution looks at is who is on that management team, what their educational background might be, their experience in the industry. You may also include key employees that may be part of the management team with specific responsibilities, perhaps in operations, finance, safety, things of that nature. Moving down, we go into the financial forecasting and cash flow. This is highly important because basically this is going to show us month by month the sales that you're going to expect to generate and the operating expenses that you're going to incur in providing either the product or the service. This is not just given at one time. This is a document that needs to be reviewed ongoing throughout the year because it's going to be able to provide actual results to forecasted results, and will give you the key information in making management decisions. So as an example, if your sales are not achieving what you expected to achieve, likely you're going to want to take a look at your expenses and reduce some of your expenses. So at the end of the day, you're going to come out close to what you had forecast as far as profit goes. Moving down, beyond that, there is any other additional pertinent information. There are certain industries within Canada that have unique things about them. We need to know what they are. We need to understand the industry that you're being involved in, and also helps us truly understand that you've done your due diligence and you're putting your best case forward, and we can rely upon the information that you've delivered. And that's my short bit, and I'm going to pass it off to Cloyd to talk about the 4 M's of commercial credit.
Excellent. Thanks very much, Doug. And just to add on to what Doug has just spoke, think of your business plan as, first impressions. How much thought and effort you put into that plan speaks volumes. And I'll just share a quick story. I received a business plan on Monday, and it was professionally done. There was a lot of information there. There were a lot of charts. There was a cash flow forecasting. There was an organizational chart. Like, it was very well done, but there was one thing, well, actually there were 2 things that stood out immediately as soon as I opened up this business plan. Number 1, it was addressed to a different bank altogether. And number 2, it was stale dated. It was dated for December 2020. Now, I can't speak for my colleagues, but I would think from a lender's perspective, this individual, this business plan has been passed by another institution, and now they're coming to me. So I'm going to go through the business plan, and I'm going to wonder why the other bank decided to pass. Now, I could be totally off, but as a lender, I think that's just how we're hardwired when we see these things. So if you're going to go through the effort and get everything done, make sure it's addressed properly, because these little things count.
I think the other thing too, Cloyd, that I'll add very briefly, and thanks for sharing that, was that the business plan you present, you should intimately understand. If you can't understand how the numbers were generated, the industry itself, then that leads us to be concerned that you really don't understand and what you're trying to achieve, and particularly the industry in itself. So I'll leave it at that. And Cloyd, you can continue on. Thanks.
Sure. All right. So to build on what Doug spoke about, I'll be speaking about the 4 M's of commercial credit. Some of you may have heard of the 5 C's of credit when that relates to personal lending. In the commercial world, business banking, we have the 4 M's: money, management, market, and materials. And as a lender, while we're reviewing your business plan, we are looking to see how you are addressing these 4 M's. And this is not just for sole proprietors and entrepreneurs. These principles work whether you're a small, stay-at-home company or a large multi-million-dollar corporation. These principles are what the lenders look for. So under money, what is the ask? How much equity is going into the project? What does your cash flow look like? What are your receivables look like? Who are your customers? Under management, who operates the company on a day-to-day basis? Who are the shareholders of the company? What is everyone's experience? What if someone were to leave? Do you have a succession plan in place? Under market, where do you operate? Are you on or off reserve? Are you local, regional, provincial, nationwide, overseas? Do you have all the proper permits? Are you meeting all the requirements to be dealing nationwide or overseas? And materials. What are you offering as collateral? What does your equipment look like? What's the life of that equipment? Are there any environmental concerns? So again, as we're going through your business plan, we're looking at how you address these 4 M's. And there's no sense in masking any potential risks. We encourage you to raise those risks and mitigate them. And perhaps you have a risk that you just can't mitigate. Maybe you reach out to industry professionals, reach out to your banker. Maybe we've seen that before. Consultants, accountants, you've got all these resources there able to assist you if you have a challenge with one of these 4Ms. And really, by reaching out and addressing it in your business plan, I mean, to me, that speaks strong management. So with that, we're going to dive into our first case study. Dejan, I will pass it on to you.
Thanks, Cloyd. I hope everyone's doing well today. I'll be taking you through the first case study, which is based on a hypothetical situation facing a First Nation. I'd like to ask you to keep in mind what my friends Cloyd and Doug discussed and try to connect this case with those learnings. Keeping in mind the components of the business plan, along with the 4Ms, will really put the story together. So without further ado, Mr. Brandt is the financial officer for a First Nation government located in rural Canada. The government is involved with several economic development corporations, including a gas station and a convenience store for the benefit of the people of the First Nation. Last month at the council meeting, it was agreed that the existing gas station has significant cash flow generating potential, but requires a sizable investment to achieve it. The gas station is a vital business for the surrounding communities, including the First Nation, and as such, this project has become a priority for the community. In early September, Mr. Brandt was assigned to take the lead on this project and has engaged a general contractor to begin work, which is estimated at $2.5 million. So, which other resources and advisors, other than the general contractor, should Mr. Brandt engage? So Mr. Brandt should engage a project manager, engineer, or an independent cost consultant, sometimes also called a quantity surveyor. The function of this role is to serve as an independent party to the project with the goal of protecting the borrower and the lender from undue risk. The biggest risk that they will look to mitigate is cost overruns. However, they will also ensure that the budget is appropriate and that the general contractor is performing their obligations as agreed. They will also periodically visit the property, review the work in place, and ensure everything is on budget. This is called a progress report and is required by banks to advance funds from the approved credit facility. Project or construction financing such as this is almost always done on a progress draw basis, where banks will only advance from the facility the work in place. So if the first progress report is at 15% of completion, the dollar amount required to get to that point is what the bank will advance to the borrower, which will then in turn pay the invoices. Another advisor which should be engaged is the lawyer or legal counsel. So this advisor will provide guidance on the optimal structure for the entity which has ownership of the project. Sometimes it's best to establish a new entity for the purposes of the project to protect from risks, including liability. So the engagement of legal counsel would ensure that the borrower and the community are protected. A third advisor, which should be engaged, is the auditor. The auditor will be able to generate a cash flow projection or forecast for the project. This is a major part of telling your story when developing the business plan. And as such, a detailed projection with sound assumptions is a key factor and can make or break your business plan. The auditor will also be able to plan for this new entity and adjust any accounting strategies to ensure proper and efficient presentation for year-end financial statements. And finally, last but not least, Mr. Brandt should engage his banker. Bankers rely on the information supported and presented by the prior three advisors to come to a conclusion on a deal structure. If there are any items specific to the project which aren't covered by the previous advisors, early engagement with the bank will reveal this deficiency and allow it to be addressed in an appropriate time as to not hinder the progress of the project. In the case that the borrower would like a second opinion on any advisors, or perhaps just needs a referral or an introduction to providers of these services, the banker is a great resource. Banks deal with all types of consultants, including the ones mentioned here, and can offer recommendations or options if requested. So now that we have all the information compiled, including guidance from our advisors, how do banks determine their appetite for the deal? Well, on a project-specific basis, a bank would look to answer the following questions. Can the project service the resulting debt obligations? And what are the threats and risks facing the project? The bank would also execute a thorough review of the cash flow projections or forecast as prepared or supported by the auditor. In a general sense, the bank is really looking at the overall financial sustainability. This includes understanding secondary and possibly tertiary sources of funding, which can be relied on in the case that the project fails to generate sufficient cash to service the debt at any given time. To understand this better, banks review appropriate government programs, funding commitments, contribution agreements, land claim settlements, and others. Finally, the bank executes a full review of the year-end financial statements of the borrower and guarantors to analyze historical performance and utilize this as a baseline to the analysis. Once the bank has confirmed everything is in order and satisfied, a loan structure will be presented. Banks will want to understand what amount of equity or cash, if any, will be injected into the project and the source of these funds. Typically in projects such as this, there will be an interest-only period offered to reduce the debt servicing requirements during the construction period. Amortizations of 25 years are also not out of the ordinary when terming out the project debt. To secure the proposed credit facility, the bank will initially look at the First Nation to obtain secondary support. If this is available, the bank will look to obtain the following security items: corporate guarantee from the First Nation, a borrowing resolution, which acknowledges and approves new bank services and financing with the bank, the nation guarantee in support of the borrower, which was the first item I mentioned, and identifying a dedicated funding source in the unfortunate event financial support is required for the borrower. The bank will also obtain a deficiency agreement from the First Nation, committing to provide financial support to the borrower in the event of any shortfalls or inability to service the proposed financing. If support from the First Nation is unavailable, then the bank would look at what other support or guarantees are available in the unfortunate circumstance where there is a gap in that cash flow. And the gap in cash flow here, which I referred to, is between the amount of cash available to service the debt and the debt servicing obligations. Other notable security and security related items include understanding the type of land in question. So Cloyd alluded to this a little bit, but we can have various situations such as on reserve, designated lands, or fee simple land. When a property is involved and is located on fee simple land, then the bank would also look at obtaining a first charge collateral mortgage. In many cases, the security structure will also include a general security agreement, assignment of fire insurance, and environmental indemnity. To conclude, we will look at any obstacles faced. A major obstacle in this project was the weather. The project began in the fall, if you recall from the case study, and was able to only progress 5 to 10% before the snow and freezing temperatures arrived and caused difficulties. This included the inability to excavate, causing a major delay to the project. So what did the borrower do in this scenario? The borrower quickly engaged their bank to explain the situation. Due to the early identification of the issue, the bank was quickly and fairly easily able to amend the terms and structure to accommodate the borrower and the changes. This included an extension of the interest-only period, allowing the project to restart in the spring and consequently succeed. In conclusion of this whole case, I would say that early engagement of advisors, not just the banker, can and usually will lead to a more optimal result for all parties involved. Last minute changes are yet usually much more difficult to accommodate and can result in the lender questioning the planning of the project. Planning for the future with the support of your team of advisors is the key takeaway, and it will drastically reduce the impact of any obstacles experienced. Thank you for your time today, and I'll pass it on to my friend John, who will take you through the second case study.
Thanks, Dejan. With this case study, it's relating to marine transport services expansion. But before I get into the specifics, if I go back to what was mentioned earlier by Doug when he started talking about the business plan, it's about telling your story. We as bankers and your financial institutions bankers, they're become the advocate of that story, telling your story and advocating that story and the importance of it. So ultimately, we are a partner, and we are a partner for your success in these projects. So to this specific case study, an economic development limited partner group that is owned by a First Nation government is involved in several economic development ventures, to which one is in marine transport services. The Marine Transport Services Limited Partnership has an opportunity to submit a proposal, a request for proposal to transport goods to various locations. The management team of the limited partnership reviewed the request for proposal and decided to submit a formal written offer. For that, though, the key component was to actually establish that business plan. It is really the key part in really putting together all the factors to meet the requirements of the proposal, request for proposal, and to look from all the financial aspects of entertaining and the risks associated to execute on a contract. In this case, when you look at that, the overview of the advisors and resources utilized for the opportunity are many. It really starts out with the accountant and the finance team of the limited partnership. And it's really to help in terms of provide support, the financial projections, which would include a profit and loss forecasting, supported by cash flow statements, sort of highlighting the working capital cycle and the working capital needs, and also demonstrate the funding or the amounts that are required for that cash flow cycle, i.e. that working capital. Second part to that is establishing the capital needs to actually execute on that specific contract. In this case, the capital needed to fulfill the contract, as you can see, is $4.5 million in marine equipment, and additional $500,000 in working capital to provide support as they deliver the goods and start to receive their revenue. One of the key things here for this particular opportunity or this proposal is the structure of the contract is based on a set rate, the revenue that they would receive per volume, in this case, 1 ton of goods delivered. So the financial forecasting really provided the framework of establishing the appropriate rate that they put in their submitted offer to that request for proposal to support many aspects of this opportunity, which is establishing the revenue with all the said expenses, provide the support necessary for the debt obligations, as you can see a significant amount here at $5 million total. And with that regard, they set that price for that proposal. The bankers involved here early, as mentioned by Dejan, the importance of that is we reviewed the business plan, including the financial forecasting and providing insight and guidance on the information presented. There's one part of this specific business plan that was brought to the attention of the group was around sort of the maintenance and expenses related to that. We felt in the proposal they were on the lighter side and didn't build the significant contingency that one would have with significant marine equipment. Now, with the revisions made, it did not significantly impact the transaction because there's other considerations, and the price that they did set was still within a framework that worked for them. But it was just important to highlight one aspect that we identified that needed to reflect more of an expense to this operation contracts. So in this case, when we review all the information, working with the limited partnership, working with the management team, assessing all the financial information, similar to what Dejan had presented and discussed, we moved forward by presenting a request, a financing discussion paper we did present to them. The factors that we, the bank, assessed to the issuance of this financing discussion paper started with what was previously mentioned, the importance of the management team, historical track record of executing marine transport contracts was very important here because this was a significant undertaking, a significant transaction, and it was a proven track record really builds comfort for us that they can execute on this larger contract. Specific to the project, the projections were deemed reasonable with those adjustments earlier mentioned, and the debt servicing was very evident that there was more than sufficient funds to cover the debt and actually provide the sufficient profit income that was needed above the debt servicing to support the risk of executing this contract. So getting full value for the work that they're doing. And then with financial sustainability, with the other aspects of the limited partnership and their other ventures, there's other cash flows that were available there, but also there was sufficient support from the First Nation government to cover any shortfalls if there was periods of some challenges that in fulfilling the contract. And what did this financing discussion paper offer? We built that working capital by giving or proposing an operating line for $500,000 that gives them that seed money to provide for all the costs, the startups, until they start seeing that revenue coming in, and that builds their cycle. We also do other products that are important, such as a corporate MasterCard for help support purchases, just for easy of accounting, managing their purchases, support there. But the key here is the equipment purchase. Based on the strength, based on the review, we were actually able to get to the 100% financing of the purchase price. We based this on 10 years, which was aligned to the contract with the understanding the type of equipment purchased had life expectancy or expectancy of 15, 20, 25 years, and if they're well maintained, even longer. When we look at our security, just at a higher level, we took a marine, or we would request a marine collateral mortgages over the equipment, these vessels. And then we do have a guarantee from that was offered and part of this proposal from the First Nation government. With all the work that was done and the submission to the request for proposal, this Economic Development Limited Partnership was awarded the contract. Now, the next stages of things really started to flow, which is getting the marine surveyor in support to provide and establishing the current market value of the equipment, because we would finance to the lesser of the value of the equipment or the purchase price, or the and also establish what needs to be completed in terms of any repairs or any things that we would match to our projections when we consider what was aligned for cost, and future maintenance. The lawyers involved as well is to provide guidance, review of the existing contract, establishing the appropriate language and subjects, including the subject to financing. As we present this discussion paper, we need to then, upon confirmation, is go through our credit adjudication and work with our credit colleagues to obtain an approval. And they also help, the lawyers are also helping with preparing of the appropriate purchase agreements to ensure the borrower, other aspects, and the specific details of that specific purchase with subjects and closing dates and other aspects pertinent to purchase agreements. When we get to that next stage there, what is any obstacles that occurred? Well, as you can imagine, when you're looking at purchasing multiple vessels of barges and tugboats and obtaining surveys, there are some surveys that were completed that they felt and it did not make sense to pursue that specific purchase because of the additional work that was required or the costs associated with it. Or in fact, they couldn't agree on the appropriate purchase price of that equipment. So what that resulted in is working with them of multiple surveys, finding the requirements to meet that obligation of the contract, which in this case was a minimum of 2 barges and 2 tugboats. And eventually through working with the Marine Survey, they're able to find the specific barges and the specific tugboats, and they made their appropriate purchase agreements. As they're working through that, we are doing our part, and the outcome was we're able to obtain their approval for the financing, and they're able to remove that subject to financing relating to their contract, and the bank provided their appropriate funds for the purchase of the equipment and setting up the working capital. You know, the read true insights here, the management team presented a well thought out business plan with adjustments that were made, but there's a lot of great work that was done there. Spent time with the bank in terms of looking at how to best help provide support. And so by them telling their story, we were advocates of their story, and working with our credit colleagues, we felt that, and they felt that the appropriateness of what our proposal was, that we're able to move forward with the project. And exciting for them because it really helps build their support of what they're doing in the marine services and helps the community at large with the income that they're anticipating and should achieve in helping the community at large. That ends sort of the case study 2. I'll pass it over to Cloyd as we will look at some questions or comments relating to our case studies and anything relating to business plans or the 4 M's of commercial credit. Thank you.
Excellent, thanks, John. So maybe we'll pass it over to Paul. Paul, are there any questions for the group?
There's no questions via the chat. We can open up, there's an opportunity here for anyone that has a question to raise your hand or to let me know. And then we'll, oh, wait a minute, question coming in. From Michael, he asks, for projects on reserve, is a funding stream that hasn't been attached to any other borrowing always required, or are there other options? Also, does project risk factor in? Example, would you allow a First Nation to secure financing for a low risk project with a funding stream that was being used to secure another loan?
Doug,
So, you gonna take it, Cloyd?
Oh, you go ahead, Doug.
Well, that's a number of things that come into play there. When we take a look at, banks generally look for a second way out in the event that things go sideways. And what we're able to do is take a look at surplus revenues from any sources. It may not be specific to an assigned cash flow, but call it general surplus funds, whatever you'd like to put on that. That can factor into the decision making as to whether or not we would support that transaction or not. So And most financial institutions don't want to tie up every dollar of revenue, surplus revenue that you have. We generally take a look at $1.25 worth of income to service debt. And as long as you're at that target, or even maybe even better, that should provide sufficient cash flow to cover the rainy day stuff or surprises that come up. When you get to a point where that cash flow is not there, then we have to get creative with the First Nation and the ECDEV Corp and possibly take a look at restructure to allow the debt to continue to be reduced in a satisfactory way. So I think what I'm trying to suggest here is if there are issues that do come up, go to your bank very quickly, present the situation to them, and together we'll find a solution on how we're going to work through that particular situation, which, excuse me, may mean adjusting the cash flow and adjusting the payment structure to accommodate that. Ultimately, at the end of the day, no financial institution wants a business to fail. And so they will try to work around and find solutions that would help. Does that cover that off?
Well, that's good, Doug. And I guess further to that, the last thing we want to do is put stress on the nation. We want to make sure that this is a viable business and that we don't need to go to the nation for support. So it really is on a case-by-case basis. What does that cash flow look like from the project? Is it an established cash flow? If so, maybe there's going to be less reliance on that support from the nation, or maybe we can rely more heavily on the project itself. So.
Yeah, I think one of the things too that we as a bank have, BMO, is that we do have an Indigenous banking group that works closely with our First Nation governments and their economic development corporations, along with the account managers that have experience in the industry. And truly understanding the transaction and understanding the community goes a long way of working together when these problems come up from time to time. No one's perfect, including us, by any stretch of the imagination. So if there is sort of disruption, let's work it out together, because the solutions ultimately have to work for both parties.
Okay, Michael had a follow-up. He asks, how does capital support, that is grants from government for a project, affect your willingness to provide financing for a project and the terms that you offer?
Well, grants can be part of a down payment factor in the scenarios that we looked at. For example, the second one, we provided 100% financing. It just meant likely that with the grant that the amount of capital required in debt would be less, but it does provide some surplus revenue, perhaps, or equity that you could utilize in other ways. But grants aren't always a determining factor as to whether we will assist or not. It's nice if you can get them. It's money that you don't have to pay interest on and repay back. So it's good. John, you want to add something?
Yeah. To grants where they.
Sorry, Doug, John, your microphone is breaking up. Can you?
Receiving. Yeah. Can you hear me again?
We can hear you fine now. Yeah.
Okay.
So if you can start your answer again, thank you.
Yeah, no problem. Yeah, so I'm currently working on a proposal where there's a specific project that is actually fully funded, provided by grants. But one of the situations for this project is sort of the challenges in terms of the timing of receiving the funding and certain requirements that they have to complete the project before they release the last components of that funding. So working with this specific nation and associated ECDEV, we basically provided the funding shortfall period, or the timing difference, by them to use our funds to continue with the project, with the understanding that with the grant money coming in, it actually then pays us out. But we also stipulated if there's cost overruns or other costs, then that we can then make a small loan or the appropriate loan for 25 years, which we do for infrastructure that helps them. So it really provides support to not delay the project because of a funding timing situation. So there's an example of grant revenue that we are using or acknowledging for this significant project and how we can support that so the project is done in a timely way and they're not putting strain on the nation to come up with those timing shortfalls. We've actually got an example of what we can do, and it really speaks to a key point here. An early conversation about anything you're entertaining or looking to do, we could just start the conversation prior to business plans, just ideas and prior support, because we can leverage the experience that we have in terms of supporting everybody in terms of what can be done and accomplished. So hope that helps answers some questions relating on the grants.
Thanks, John. Our Michael says thank you as well for answering that. Are there any other questions? We've got these 4 bankers with us. It's time to ask some questions. Put them in the hot seat.
Maybe while we're
Turn the
waiting for some questions.
tables on them.
Yeah, maybe while we're waiting for questions, I'll just say that while we use 2 specific examples here, the principles at play would work no matter what industry or service that you're looking at providing. The key thing in any relationship is obviously ensure that it's a positive relationship going both ways. And financial institutions don't necessarily have to be viewed as someone that's difficult to deal with. In fact, I don't think we are in many cases, but it's just getting to know each other. And if you don't feel at this point in time that you're at that level with your existing bank, make an effort. And at the end of the day, if they're still not being able to deliver what you'd like, then obviously you have the options to approach other financiers in the marketplace. See, there was a question that came up.
Yeah, Debbie asks, do interest rates reflect risk on loans?
Well, I suppose in the environment where it's really low now and should rates go up, so if you haven't locked your rates in and it's variable, it could put pressure on cash flow when it's renewed at a much higher rate. Is it the biggest risk factor? Hopefully not. I think that there are other risks that would probably be greater than that, depending on the industry that you're in. But yeah, it can provide some risk if you haven't locked your rates in.
I think as a prudent lender, we do stress test, right? We know, if this is a 25-year loan and interest rates are at 2-3% right now, we know it's not going to be that low for the entire duration of the loan. So we do stress test, and that's where we look at your cash flow. How strong is your cash flow? Can you meet your obligations if interest rates were to rise 2, 3, 4%? So yeah, we do. It does pose a little bit of risk, but we take all of that into consideration.
Okay, Michael asks if the remoteness and or amount of members on and off reserve affect your interest rate and viability.
Again, that depends on the industry and what you're trying to do, but I would say that we deal with many size communities, both small and large, remote and urban, and it's not a barrier to us to have a relationship and provide financing for. Again, it just depends on the transaction at play.
Okay, thanks, Doug. Any other questions at this point? So just as a reminder, this session recording and the presentation materials and case studies will be available about an hour or 2 after the session ends at the edo.ca website. Go to links to learning and click on the webinar Wednesday, and we'll have those materials there. So if you think you've missed some information or you couldn't see it in the presentation, you'll be able to download that for yourself and review those materials.
Yeah, I think all our contact information's on our session that we provided as well.
Yeah, it's on there.
Debbie S. has a follow-up question. Are clauses put into loan agreements for on-reserve assets if liquidation is required to access the assets?
So believe it or not, when we're dealing with First Nations, often the only security that we're taking is a band council resolution authorizing the debt. If we're taking a look at the overall cash flow for the nation, we're obviously looking at historical. And if it says that they can service the debt, that's typically what we have. So we're not really taking security per se. We've had many scenarios in the 17 years that I've been with Bank of Montreal where in fact we took no security because the relationship that we had with the nation, the historical cash flow that they had was so strong, it really didn't warrant it. And we trusted them. And I know that often a lot of policies and financial institutions are based upon clients that don't honor their obligations. But I'll tell you what, in this area with First Nations, we've had no losses. So therefore, we tend to be far more liberal in the support that we provide based on that.
So just to add to that, if this is an entrepreneur and this is a piece of equipment that the business owner has that is located on reserve, then perhaps if we do want to tie our hands on that equipment, we may ask for a right of access from the nation in the event that we want to recoup that asset if we encounter a default scenario. It really depends. It is on a case by case, but as far as the clause, an agreement or something like that goes, I would say a right of access is something we would kind of look at.
Thank you very much, Cloyd. Okay. We're just looking. There's a lot of thank yous, everyone. So they appreciate you taking the time to answer their questions. So if there's nothing further, we'll just wrap this up. I'm just going to turn on the camera. So thank you so much for taking time out of your busy schedules to spend it with us. We know there's many options and many choices for the use of your time these days. So we thank you for spending an hour with us on a webinar Wednesday for Cando. Thank you to Bank of Montreal for sharing their insights and their expertise and their willingness to work with those that are in attendance. So if you want to follow up with any of the presenters, the contact information will be available in the downloadable presentation file that we'll have on their website, which I've mentioned numerous times. So if there's nothing further, thank you all, appreciate it. And please stay tuned on the website and social media because we have regular webinar Wednesday opportunities to provide training and skill enhancement and maybe open up different perspectives on some initiatives that are under